Hello everyone, it's Wee from weeconomics, and today I thought I would like to very briefly talk about some macroeconomics. Now, I'm not an economic expert or anything, and these are just how I've understood the economy. So basically today I'd like to take a few minutes to talk about why interest rates are so low during times like this, like a pandemic. Basically, there are two main reasons why the government has set a very low overnight policy rate, or what we will eventually know as interest rate. And the two reasons are to discourage any savings and to encourage more spending. So how does this work is basically when the government sets a very low interest rate, this will be reflected in the interest that the banks will give us, whether it's for a savings account or for a fixed deposit. So when the interest for savings accounts or for fixed deposits are very low, then people would think that keeping money with the bank is not worth it, because you can't even beat let's say an inflation rate of 3%. So even though the banks are basically zero risk, people just think that it's not worth it to put your money there and lose value. So they would rather take it out and maybe invest in the stock market. That's why you see many people who have never touched the stock market actually start to get into these kinds of investments. And the other reason is to encourage spending, and how they do that is that when they decrease the interest rates, it actually becomes much cheaper to borrow money, right? If you have recently checked on house loans and car loans, you see that the interest rates that you need to pay back the bank are actually much lower than usual. Especially if you have been paying your car loans and housing loans all this while, you will realize that the value that you have to pay every month has actually decreased. So if it's much easier now to borrow money, right, as in you have to pay less, then more and more people will borrow money and they will buy cars, they will buy houses, and this will actually stimulate the economy. And it's not only that, right? Businesses can now borrow more money to actually pump into their business, to expand, to hire more people, to create more products, and this will eventually lead to more jobs, more production, and yeah, in a way it can stimulate the economy. So this will generally happen during an economic downturn. For example, right now when we're having a pandemic and the economy is not particularly good, and it's a way for the government to actually save our economy, so to say, right? But are there any negative effects to this? Definitely. When people start to borrow more easily, right? Let's just take a very simple example. Let's say just houses and cars, right? When people are able to borrow much more easily, when they are able to have more purchasing power, then prices would actually increase, right? Because if more people can afford to buy houses now, if more people can afford to buy cars now, then the demand will actually increase, and this will actually cause something called demand pushed inflation. Okay, and this will basically just increase the prices of stuff, of houses and cars, right? And if this goes on without control, then the prices will just keep on going up. Okay, so it's a very delicate balance that the government has to do to basically try to stimulate the economy without things getting too expensive. Okay, because if things get too expensive, then they would have to increase interest rates again, and this will actually slow down the economy to prevent prices from going out of hand. Okay, so yeah, that's basically a very simple way of understanding the effects of interest rates. Right? If you have any questions, you can just leave a comment below or DM me at weeconomics. Right? If you enjoyed the video, you can hopefully like and maybe subscribe to my channel. I'm Wee from weeconomics, and until the next video, peace.